Welcome to LuzFama, where we decode the truth behind global markets one move at a time. If you've been watching gold and silver lately, you've probably noticed something unusual. A lot of movement, a lot of emotion, and a lot of confusion. But behind all this noise, a bigger story is unfolding, a story that could change the financial world as we know it. So if you care about your wealth, your savings, or even the future of money itself, then stay with me till the end, because what's happening now is not just a price correction, it's a signal. Gold's recent pullback might look like weakness on the surface, but as any experienced trader knows, the market often breathes before it runs. After rallying all the way from around 3,350 to above 4,400, gold was due for a rest. What we're seeing now is not collapse, it's consolidation. Technical charts are pointing to possible support zones around 3,170 and 3,148. These are levels where, historically, strong hands start to step back in, and when that happens, the next wave can often be explosive. Gary Wagner and Mike Maloney, two highly respected voices in precious metals, have both highlighted that this pullback fits perfectly into a larger Elliott wave structure. According to this view, the market completed its first big wave higher and is now in a second wave correction. Once this phase ends, a massive third wave could begin, one that breaks past $4,400 again and pushes gold into uncharted territory. Think of it like taking a deep breath before sprinting again. This isn't just about gold prices, it's about what gold represents, confidence. Every dip in gold's value isn't just a technical event, it reflects shifts in how investors feel about the global financial system. And right now, those feelings are complicated. Inflation continues to eat away at currencies. Central banks keep expanding their balance sheets, and government debt around the world is hitting levels never seen before. In moments like these, gold doesn't lose its shine. It simply pauses, waiting for the next storm to hit. Silver, too, is following a similar rhythm, showing strong potential once this short-term consolidation phase is over. Wagner believes silver is setting up for a breakout to $55 or even $60 once the correction finishes. It's not just optimism, the technicals support it. Silver tends to outperform gold when both metals are rising. And this time, as global industrial demand grows alongside financial demand, silver's dual nature gives it even more potential energy. Now, here's something interesting. This current correction in gold is roughly around 10%. That might sound big, but in context, it's actually quite healthy. A 10% to 12% retracement after a $1,000 rally is not only normal, it's necessary. Think of it as a market taking profit, cooling off, and preparing for the next phase. Once that stabilization completes, possibly around the Fibonacci retracement levels mentioned earlier, we could be looking at the start of a third wave that historically has never been the smallest. That means if the pattern holds, gold could easily break into new highs above $4,500 or even $4,600. So what we're really watching here isn't panic, it's preparation. Each red candle, each pullback, each moment of doubt in the market is just setting the foundation for the next powerful move upward. The biggest mistake traders make during these times is losing patience. But as history has shown again and again, gold doesn't move in straight lines. It moves in cycles. And when the correction ends, it doesn't just bounce, it explodes. This is just the beginning of the story. In the next part, we'll go deeper into the technical setup, what the Fibonacci levels actually mean, and why this wave pattern could be the most powerful rally we've seen in years. Stay tuned, because what comes next could redefine how investors see gold forever. When we look closer at gold's recent movement, something fascinating appears on the charts. The price action isn't random, it's following a structure, a rhythm that traders who understand Elliott wave theory will instantly recognize. After a strong first wave rally that took gold from around $3,350 all the way past $4,400, we entered what looks like a classic wave 2 correction. It's that moment when the market pauses, traders start to take profits, and new support zones begin to form. But in the bigger picture, this correction is just the market preparing for what could be the next major surge, the third wave, which is historically the most powerful of all. Gary Wagner mentioned that if gold finds support around 3,170 or 3,748, it would match the classic Fibonacci retracement levels, the 50% and 61.8% zones that often mark the end of a pullback. These levels are not just numbers, they represent balance points in the market, areas where the energy that pushed prices higher in the first wave gets recharged before the next breakout. So when traders see gold testing these zones, it's not a sign of weakness. It's the calm before the next move. Wagner also pointed out that the current correction has already given back around 10.5% of the total rally, which aligns almost perfectly with typical retracements in healthy bull markets. In other words, this is a textbook scenario. Even if gold dips slightly lower, say toward $3,748, that doesn't change the overall trend. The structure remains intact. What really matters now is how the price behaves once it hits those supports. If we see smaller candles forming, long wicks on the bottom, or a hammer pattern on the daily chart, those could be the early signs that the correction is nearing its end. On the emotional side, this is the stage where most retail investors begin to panic. They look at the red candles, the pullbacks, and start thinking the rally is over. But professionals know better. Markets move in waves, and wave 2 corrections are designed to shake out the weak hands, to create doubt before the next big move begins. That's why this phase feels so uncertain. It's meant to. The market tests conviction, removing those who trade on emotion and rewarding those who trade on understanding. There's another reason why this correction feels so strong, because the first rally was unusually sharp. A move of nearly $1,000 in a few months is massive for gold. When a rally of that size happens, it's natural for the market to breathe and adjust. Think of it like climbing a mountain. You don't reach the summit in one go, you stop, you rest, and you gather energy. That's exactly what's happening here. This pause is a recharge before the next climb. Fundamentally, nothing has changed. The same forces that pushed gold up before, inflation fears, geopolitical tension, rising debt, and currency devaluation, are all still here. If anything, they've only intensified. Rate cuts from central banks, ongoing fiscal instability, and slowing global growth are all bullish for precious metals in the long run. Every correction inside a bull market should be seen not as a warning, but as an opportunity to position wisely before the next rally. Silver is mirroring this same pattern. Just like gold, it has broken through its initial resistance, rallied strongly, and is now taking a short break. The difference is silver tends to move faster. It rises more sharply during rallies and falls more quickly during corrections. That's why many analysts, including Wagner and Maloney, expect silver to outperform gold in the next major leg upward. The charts tell the same story. Both metals are forming the same foundation, a series of higher highs and higher lows, which often marks the build-up to a breakout. Once gold stabilizes and starts pushing back above $4,000 with strong volume, the momentum could return very quickly. The same goes for silver once it finds solid footing near its retracement zone. So, while the average trader is waiting in fear, smart investors are quietly watching these support levels, ready to act when confirmation appears. This correction isn't an ending. It's the setup for something much bigger. In the next part, we'll explore why this movement goes far beyond charts, how global events, economic policy, and even political uncertainty are aligning to create a perfect environment for gold and silver to rise again. Because when fundamentals and technicals point in the same direction, the results can be extraordinary. When we zoom out and look beyond the charts, we begin to see that the story of gold and silver is not just about numbers. It's about global confidence. Right now, central banks across the world are in a very delicate position. After years of aggressive interest rate hikes, inflation has not been fully controlled and economic growth is slowing. That's a dangerous mix, because when economies slow while debt continues to rise, governments start searching for a way out. And history shows that they usually choose the easy path, printing more money. This is where the conversation shifts from technicals to fundamentals. Gold and silver are not just commodities, they are reflections of trust. When people lose faith in paper currencies or governments, they turn to assets that have stood the test of time. In recent months, we've seen central banks from China, India, and even smaller nations quietly increasing their gold reserves. They're not doing this by accident. They're preparing for a potential shift in the global financial system. The US dollar, once seen as the ultimate safe haven, is now facing challenges on multiple fronts. Countries are exploring trade in local currencies. The BRICS alliance is discussing alternatives to dollar settlements, and US debt is at levels that were once unimaginable. Every time the US government raises its debt ceiling, it signals to the world that the system depends on borrowing more just to stay alive. That's not a sustainable model, and markets know it. When Mike Maloney talked about the gradually, then suddenly phase of wealth transfer, he was describing exactly what we're seeing today. The transition starts slowly. Small shifts in policy, quiet accumulation by central banks, minor currency devaluations. But at some point, confidence breaks. And when it does, the move into gold and silver accelerates rapidly. That's the suddenly part. What's happening right now feels like the setup for that moment. Inflation may have cooled slightly on paper, but the cost of living remains high across the globe. Energy prices, housing, and food costs are still elevated. Wages haven't kept up. This creates social and political pressure, and governments respond by increasing spending. More spending means more debt, and more debt means more currency dilution. It's a cycle that leads directly to higher gold and silver prices over time. On top of that, geopolitical uncertainty is rising again. Tensions in the Middle East, instability in Eastern Europe, and trade disputes between global powers are pushing investors towards safe haven assets. Every headline that creates fear in the markets strengthens gold's position as a store of value. Silver benefits as well, especially because of its dual role as both an industrial and precious metal. India's role in this environment is particularly interesting. It has always been a massive consumer of gold, both culturally and economically. But now, India is also positioning itself as a bridge between the West and emerging markets. If India continues to accumulate gold and diversify away from dollar-based assets, it adds another powerful layer of demand. Combine that with China's ongoing gold accumulation, and you begin to understand why analysts believe we're only in the early stages of this bull run. So, while technical charts give us price zones and timing signals, the fundamentals provide the reason. And right now, both are pointing in the same direction, upward. The correction we're seeing isn't a collapse. It's a necessary pause before the next major leg of the wealth cycle begins. The world is quietly moving from paper promises to tangible value, from digital illusion to physical security, and gold and silver are at the center of that transformation. In the next part, we'll explore how this shift could affect everyday people, how the coming financial transition may create one of the biggest wealth transfers in modern history, and how those who prepare early will be the ones who benefit the most when the suddenly phase begins. Every major financial cycle in history has had one defining feature, a moment when wealth silently changes hands. It doesn't happen in the open, there's no announcement, no warning, it happens quietly while most people are distracted, scared, or uncertain. That's what we call the wealth transfer phase. It's the moment when retail investors sell out of fear and institutions buy with confidence. And right now, we are standing on the edge of that moment once again. The gradually then suddenly shift that Mike Maloney described is not just a phrase, it's a pattern that repeats across centuries. At first, people don't notice what's happening. Prices rise slowly, corrections shake out weak holders, and news outlets keep saying everything is fine. But behind the scenes, the real players, governments, central banks, hedge funds, are preparing. They're quietly repositioning, moving capital into hard assets, and building safety nets while the public remains focused on short-term moves. That's the stage we're in now. The market correction in gold and silver has created uncertainty. People are questioning whether the bull run is over, whether they should exit or wait. And that's exactly when history shows us that the biggest opportunities appear. Because when fear is high and prices are pulling back, that's the window when accumulation happens, when wealth quietly shifts from those who panic to those who understand. It's easy to underestimate how powerful emotions are in financial markets. Every investor knows the logic. buy low, sell high. Yet in practice, most do the opposite. They buy when headlines are euphoric and sell when fear dominates. It's not because people are foolish, it's because markets are designed to test conviction. The constant noise, the red candles, the sudden pullbacks, all of it works to shake confidence. Only those who truly understand the bigger picture stay calm enough to act wisely. This is why understanding both the technical and fundamental sides of the market matters. When you see a correction happening within a larger uptrend, and when global fundamentals still support higher prices, that's your confirmation. Right now, we have both. The technical setup shows gold consolidating within healthy Fibonacci zones. The fundamentals, rising debt, geopolitical tension, and currency devaluation, remain firmly bullish. This combination doesn't happen often. What's coming next is a potential redistribution of wealth on a global scale. As paper assets lose credibility and inflation erodes savings, tangible stores of value like gold and silver begin to shine. Historically, during these transitions, a small group of informed investors, those who recognize the signs early, capture life-changing gains. They don't follow hype, they don't react to fear, they position themselves before the crowd realizes what's happening. And make no mistake, this next phase won't be gradual. It will start slowly, then unfold all at once. A sudden policy announcement, a financial crisis in a major country, or an unexpected move by central banks could trigger a sharp revaluation in precious metals. When that moment arrives, prices move so fast that by the time retail investors try to jump back in, the opportunity is already gone. That's what suddenly truly means in this cycle. This is why education and awareness are so critical right now. Understanding the nature of this transition, not just emotionally but structurally, gives you a clear edge. You begin to see corrections not as threats but as opportunities. You stop chasing trends and start positioning ahead of them. That's how every major wealth shift has rewarded those who paid attention when others looked away. The truth is, the next few years will not just test portfolios. They'll test patience, discipline, and belief. Markets are psychological battlegrounds where fear and greed compete for dominance. Those who master their emotions will master the outcome. In the next part, we'll explore what signs to watch for as this shift accelerates, how to identify when the suddenly phase begins, and how to stay ahead of it before the masses even realize what's happening. Because when that moment hits, it won't wait for anyone. If you pay close attention, the signs of this great financial shift are already appearing. They're not always obvious at first glance. They're subtle, hidden between headlines and economic reports. But to those who understand how markets move, these signals are like flashing lights on the road ahead. Central banks, corporations, and even governments are quietly making moves that reveal their true expectations for the future. One of the biggest clues lies in central bank gold purchases. Over the last year, data shows that central banks have been buying gold at the fastest pace seen in more than half a century. China, India, Turkey, and several Middle Eastern nations have all added to their reserves. This isn't a coincidence. When the most powerful financial institutions on earth start converting paper assets into gold, it means they're preparing for instability. They're not speculating, they're protecting. That alone should make every investor stop and think. Another sign comes from the bond market. Yields have risen sharply in recent months, which sounds like good news on the surface, but it actually signals deep concern underneath. Higher yields mean investors are demanding more return to compensate for risk of inflation, default, or currency loss. Historically, when bond yields rise while confidence in government debt falls, gold and silver become the natural alternatives. They are, in essence, the insurance policy against the system itself. We can also see this shift in corporate and institutional behavior. Major funds that once avoided precious metals are now allocating small but growing percentages of their portfolios to gold and silver. The same trend is appearing among high net worth investors who are diversifying away from traditional markets and quietly moving into physical assets. This gradual repositioning of capital tells a story, one that the mainstream media rarely covers until it's too late. Even technology is reflecting this transition. Blockchain-based gold tokens, digital silver certificates, and tokenized commodities are gaining traction. This shows that the market is not rejecting technology. It's merging it with real value. We're witnessing a hybrid era where physical wealth and digital efficiency meet, and that could redefine how investors hold assets in the future. But perhaps the most telling sign comes from the retail side, ordinary people. When the average investor starts to lose faith in traditional banking systems or fiat currencies, they begin looking for alternatives. We've seen growing interest in gold ETFs, silver coins, and even small-scale mining stocks. Yet most of the public still hasn't acted. That's exactly how it always happens. The first movers are the quiet ones. They act early, while the majority waits for confirmation. And when confirmation arrives, prices are already much higher. You can also see the signs in global trade. Countries are increasingly settling deals in their own currencies instead of the US dollar. This trend may seem slow, but it chips away at dollar dominance bit by bit. Once that confidence erodes past a certain point, the revaluation of real assets like gold could happen very quickly. That's the suddenly phase we've been talking about, a rapid shift in perception that changes prices overnight. The media will frame it as a surprise, but those who have been watching closely will know it wasn't random. The buildup was visible all along. Central banks accumulating gold, investors diversifying, currencies fluctuating. All these threads connect to one outcome, a rebalancing of value from paper to metal. When that phase begins, volatility will surge. Markets will swing wildly, currencies may weaken sharply, and digital assets could see temporary turbulence. But those who are positioned correctly, those holding real, tangible stores of value, won't see chaos. They'll see opportunity. This is why awareness matters more than prediction. You don't need to know the exact date or headline that triggers the shift. You only need to understand the structure that leads to it. And that structure is already here. In the final part, we'll bring everything together, the technicals, the fundamentals, the psychology, and the signs, to show how you can stay calm, focused, and strategically positioned in what could become one of the most important financial transitions of our time. As we reach the end of this analysis, one thing becomes crystal clear. The world is entering a new financial era. What we've seen so far in gold and silver is only the beginning. The correction that many feared is not a sign of weakness. It's the deep breath before the next climb. Every chart, every policy move, and every quiet decision made by global institutions points toward one outcome, a gradual but undeniable shift from paper value to real value. And when that shift fully unfolds, it will change everything we know about wealth, security, and power. For months now, central banks have been telling us their story without words. They're buying gold. They're reducing exposure to the dollar. They're hedging against the very system they built. Meanwhile, governments are printing, spending, and inflating more than ever before. This is not a coincidence, it's preparation. The smartest players in the world are positioning before the next phase begins. The question is, will ordinary people do the same, or will they once again arrive late after the move has already happened? We've talked about the technical patterns, the Fibonacci retracements, the Elliott waves, the corrections that test patience but build structure. We've discussed the fundamentals, the rising debt, the geopolitical tensions, and the loss of trust in paper assets. We've explored the psychology, the fear that drives retail investors out, and the calm strategy that allows professionals to accumulate silently. All of these layers connect into one complete picture. We are living through one of the biggest financial turning points in modern history. But here's the truth that most people miss. You don't have to be a billionaire, a central banker, or a hedge fund manager to benefit from it. What matters is awareness. What matters is timing. Every great financial transformation has given an opportunity to those who were paying attention while others were distracted. The 1970s had it, the 2008 crisis had it, and now this era of digital illusion and paper over leverage is creating the same setup again. The next wave won't just reward investors, it will reward those who understand conviction. Because when gold breaks through resistance and silver follows with momentum, it won't just be a market move, it will be a statement that real value still matters in a world that forgot what value means. And those who positioned early, those who trusted knowledge over noise, will see the rewards that come only once in a generation. This is why the LuzFama community exists, not to chase hype, but to stay informed, disciplined, and one step ahead. We analyze not because it's easy, but because truth hides in the details. Every number, every candle, every policy decision tells a story. And when you learn to read it, you no longer react to markets. You understand them. The coming years will test everyone, not just financially, but mentally. Markets will swing, headlines will create fear, and doubt will return again and again. But those who stay grounded in facts, who stay calm in volatility, will turn uncertainty into advantage. The difference between panic and preparation is knowledge. And that's what we build here together. So, as we close today's discussion, remember this: wealth doesn't disappear, it transfers. The only question is, to whom? The gradually, then suddenly moment isn't a myth. It's unfolding now, piece by piece. And when the suddenly arrives, it will reward those who saw it coming, not those who waited for confirmation. Stay alert, stay informed, and stay ahead. Because the next chapter of global finance isn't being written in headlines, it's being written in the quiet moves happening right now. This is LuzFama, where knowledge becomes power and preparation becomes wealth.